Silver and gold spot prices had a mixed week, showing some strength to begin, only to recess in the closing days. The gold spot price is closing the week around $1,293 per troy ounce in fully fiat Federal Reserve notes. The silver spot price appears to be ending this week right around the psychologically important $15 per troy ounce level. In this week's Metals and Markets, we have a new guest to the show. Jordan Roy-Byrne, the editor and publisher of thedailygold.com, will join us after this brief message from our show's sponsor.
SDBullion.com is a high-volume physical gold, silver, and precious metal dealer. Founded in March 2012 with the goal of providing the lowest cost bullion available, SD Bullion has become one of the largest US-based precious metal dealers and is regularly recognized by Inc. magazine as one of America's fastest growing companies. Having now served over 100,000 customers around the world with over 10,000 positive online reviews, SD Bullion continues to gain industry market share by being one of the premier low-cost options for physical precious metal bullion buyers and sellers. At SDBullion.com, you can order your guaranteed physical precious metal bullion products online, 24 hours a day, 7 days a week. Discreet, low-cost delivery is both fast and always fully insured. You can also choose to purchase various qualifying gold and silver IRA products, which can be held in your individual retirement account for long-term wealth preservation. We are committed to being your trusted source for low-cost, highest quality investment-grade bullion products. Visit SDBullion.com for more information.
Welcome to this week's Metals and Markets Wrap. I'm your host, James Anderson of SD Bullion. With us this week, he's a new guest to the show. His name is Mr. Jordan Roy-Byrne of thedailygold.com. Jordan, thanks for taking the time to come onto our show and taking the time for us.
James, thanks for having me on. It's a real pleasure to be on your show.
Yeah, no problem. I'm excited to have you on. It's good to finally get to speak with you. I've been watching your work over the many years that I've been in this industry, and it's good to finally engage. So I wanted to give you the chance, if you could, to give our listeners a little bit of background as to who you are and how you got involved in the gold and silver precious metal industry.
Well, I got involved really as an investor first. My professional background is in technical analysis, so that's how I come at it. But I basically first heard about precious metals in around 2000, and I kind of ignored it because I first started investing in the late 90s, and of course I got into tech stocks. And when that bubble collapsed, I was still buying stocks on the way down, and I actually came out ahead because I got in early enough. But after buying things on the way down and that basically not working, I realized there had to be another way to figure out how markets are moving, and so that basically led me to technical analysis. And then there were some people in my life that were mentors, and they mentioned precious metals really early on, and commodities also in the early 2000s. And I always had gold. I always had my eye on gold, but kind of from afar. I got into energy first because that was easier to understand. I mean, the companies made money, really quickly, unlike precious metals mining companies. But I kind of went full on big into gold in 2004, 2005. So, ever since I've, learned a lot about it, learned a lot about the companies and the mining business and the junior mining business. And so that's basically, led me to where I am now.
So your specialty is certainly in the mining industry and with precious metals mining specifically.
Yes, I would say technical analysis, and then what I focus on is technical analysis and kind of you could say technical macro analysis of gold, and then trying to pick the right companies, the right juniors which can perform. So that's where my expertise is.
Now, this is just a standard rebuttal that I commonly see against technical analysis. I think some of it is rooted in the fact that it can be overly complex at times, and that some people maybe they just kind of throw it out with the baby with the bathwater in a sense. They're just like, oh, we work in manipulated markets, so your technical charts don't mean squat. That's kind of like the rank trolling that goes on online. What do you typically say to people who say stuff like that?
Yeah, I've heard that quite a bit. Well, there's a couple things. First of all, I like what you said about too complex, because what a lot of times what you see from amateurs is they have bizarre lines all over their charts, and like when you see more than like a couple lines, if you're a person who doesn't really follow or know technical analysis, if you see bizarre lines there's just lines all over the chart, you can just ignore it. I mean, it's just garbage, for lack of a more respectful opinion. But really, technical analysis is about, yes, you have to simplify it, and it's about interpretation. I mean, every time I've gotten something wrong, I've had a false interpretation, or there's something I haven't looked at appropriately. Like, for example, at the end of last year, last October, November, I was thinking the stocks could, have another leg down. And what I kind of ignored is I started tracking breadth indicators, looking at, okay, what percent of the juniors are trading above the 200-day moving average. And, that got down to, I don't remember, but it got down to like 0 or 5%, which means like it's essentially extremely oversold, and it's very likely not to break down. And so that's, when I was too bearish on the market, that's something I ignored. So when the market started to rally, I immediately knew, look, here's something that I ignored. So a lot of times when people technical analysis, it's not always going to be 100% predictive in the direction you think it is, but I mean, it can help you understand, okay, here are the possibilities of how this could play out. And so it's really about interpreting and evaluating the information that's there as best as you can. And I mean, like I said, the many times I've been wrong about something, it hasn't been a manipulated market. It's really been me having the wrong interpretation, like I'm missing something. So I mean, that's what I would say to that.
Cool. So you did bring, before we got on the interview, you emailed me a few charts. I think there was 3 in total. And so for those listeners out there that are just simply listening through a podcast, like iTunes or on their phone or what have you, there will be a few charts in the video. So if you want to refer back to our YouTube channel, you could find the charts visually and watch the YouTube version of this podcast. But Jordan knows that as well, so he may further explain how the chart looks, just so if you're listening, you can follow along, at least in general terms. So if you don't mind me bringing up that first slide we got here, Jordan, we have slide SC-9. Could you describe what this chart is telling us?
Okay, well, this chart looks at basically the last 25 years or so of the Fed funds rate, and then the 2-year yield, the yield curve, which I use 2s and 10s for that, the 2-year and the 10-year. And then I have gold stocks at the bottom, the HUI. And essentially here what we're looking at is what happened the last 2 times the Fed basically began a new rate cut cycle. And so we're looking, and those new rate cuts were January 01 and September 07. And before they started to cut rates, the 2-year yield, which the Fed, I mean, that tends to lead the Fed in both directions. So the 2-year yield, that peaked months, I'm looking at it, that peaked, potentially like a year or so before, those 2 rate cuts started. And in the last week or so, yields have kind of rebounded. But what we've already seen is the 2-year yield this time around, that peaked, I believe, in, I want to say November, close to 3%. So the 2-year yield peaked in November, and then the Fed had its, what appears to be its last hike in December. So the 2-year yield has trended from almost 3% down to, I think it got at about 220, maybe a little bit below. But like I said, it's having a bounce now. And if you go back to the last 2 rate cuts, the 2-year yield had a sharp downtrend. Well, not that sharp, but it trended down for several months, more than several months, before the Fed actually cut rates. And so when the 2-year yield started to trend down, that's that was the first thing that happened. The second thing in the cycle was the yield curve started to steepen. So you get the inversion first, and then when the market senses a rate cut is going to come, then the curve starts to invert. Then when the Fed actually cuts, then it steepens aggressively. But where gold and gold stocks come in is basically they start to perform and really outperform the stock market. It's when the cut happens and after the cut. So obviously, the Fed, what we've seen in the last couple of weeks is the Fed or the Fed futures market has been projecting that we're going to get a cut later this year. Basically, there was the percentage chance of a cut later this year has been really high. Now, since that time, like in the last week or two, we're seeing a reversal of that where, the stock market is starting to do well again. And so, the market is kind of sensing, well, there's probably going to be tighter policy. We have to shift our expectations. So, that's not good for precious metals. But the real big picture here is, judging from the last two cycles, and look, every cycle is different. I mean, I'm using the two recent examples.
Right.
But basically, the key, when are precious metals going to start to perform better than the stock market? That's going to happen basically when the Fed cuts. So it doesn't happen before the cut; it happens when they cut. So that's something to keep in mind. That when they do cut rates, that's really the trigger when precious metals will start to perform much better and much better in relative terms.
Correct, and I definitely sense just from listening and watching people on financial Twitter that there are a lot of people that have expectations that the Federal Reserve is going to have to cut at some point. And the question is, will it be in 2019, 2020? And of course, if they do and when they do, precious metals stand to gain, very strongly versus other asset classes. So I suppose we can move along. Slide number SC-10. What are we looking at on this slide here, Jordan?
Yeah, so here we're looking at basically two gold stock indexes that go back decades and decades. So I have basically gold stocks plotted against the stock market. At the top, that's the S&P TSX Gold Stock Index, which goes back to 1929. And at the bottom, I have the Barron's Gold Mining Index versus the S&P 500. That goes back to 1938. And so what you see is that basically gold stocks, where they are currently, is basically, they're, as far as how cheap they are relative to the stock market, they're basically around all-time lows. And the way these ratios look on like a bird's eye view is they're basically making a major long-term bottom similar to what happened around 2000 and then in the early 1960s. So, I mean, that's really where, if we're looking for a historical comparison, and I like to use the gold stocks because they go back much farther than gold, which, as we know, has basically only been freely traded since 1971, when we removed the final link with the gold standard, which has had awful historical implications. But I don't want to go off on a tangent down a rabbit hole. So
Sure.
So anyway, the big picture here is gold stocks versus stock market. Gold stocks are extremely cheap in relative terms, and the best historical comparison to me looks to be like the early 1960s, and that really makes a lot of sense on a number of levels. Mm-hmm. That's basically what I'm looking at, and the trigger for gold stocks to start to perform better is the rate cut, which I mentioned during the last chart. So that's yeah.
So just judging by the visual of this chart, I mean, it looks to be rounding up in the 2020s and potentially doing a rhyme of the 1970s, or perhaps even some type of rhyme in the mid 30s, even for major junior mining shares that produce gold on a heavy level. That's at least just from what I'm gathering from the visuals of this. Is that correct?
Yes, that's correct. I mean, it basically, in relative terms, it appears to be that we will see precious metals strongly outperform in the next decade. And again, because people, people have been saying that for many years, and when's this going to happen? We haven't had the bullish fundamental developments we need yet for capital to shift from stocks into precious metals. I mean, yes, granted, the major, if we're looking at decades and decades of history, yes, the fundamentals for gold are there. The price is going to go much, much, much higher. But as far as, again, when is this thing going to shift in the direction of precious metals? It's when Fed policy shifts.
Right. And when you have true capital flows, I mean, institutional type money start flowing into mining shares, the prices and the performance could get bonkers, essentially.
Correct.
All right. So moving on to the final slide we have for the day, slide SC-11. What are we looking at on this one?
So in this, we go back to about 1970, and we're looking at basically we have two charts, in this one image, and we have in black, we just have gold, nominal gold, and then in blue, we have gold against the stock market, which is gold against the S&P 500. And basically what we need to know is gold has never had a bull market without outperforming the stock market. I mean, a real bull market. Now, the only exception to that is the mid-80s, 85 to 87. But during that time, we had a massive decline in the dollar. Like, as the listeners probably know, again, a massive decline in the dollar. And gold, given that, gold really should have performed a lot better. I mean, it still performed well in nominal terms. But that's basically the one exception to the rule here. And the rule is, gold is not going to, gold and gold stocks, we're not going to see them go into a major bull market until they outperform the stock market. And so, what we've seen since that low at the very beginning of 2016 is the gold to S&P 500 ratio that has made a lower low since then. That is still trended lower. And it looks, similar to what happened in the mid 90s where, gold had this, it popped in 1993 or so, and then it kind of stabilized for a couple of years. But, relative to the stock market, that ratio started to trend down. It looks at like 95, 1996, and really fell off a cliff. And, that happened before gold in nominal terms fell off a cliff. So basically, the point is, if there's a real bull market in precious metals, they're going to be outperforming the stock market. And sadly, they haven't been outperforming the stock market. Even they've held up okay the last couple of years, but they haven't been outperforming the stock market. And so, this gets back to the fundamental catalyst that I'm talking about. The Fed will cut rates when the S&P weakens and economic data weakens. As the Fed cuts rates multiple times, like when they get in a new cut cycle, it's not always the first cut where the market rolls over. Sometimes it's the second and third cut. So I would just keep that in mind. When the Fed actually starts a new cut cycle, that'll be the time when precious metals start to outperform the stock market. The stock market rolls over again. Precious metals are rising in both nominal and real terms, but we don't have that yet. So this is, there's people who've already said, we're in a bull market, we're in an invisible bull market. That's not the case because it isn't being confirmed by outperformance of gold and gold stocks against the stock market.
Mm-hmm. And just one point that I found in my own research here at Metals and Markets, I threw up a chart that is an interesting one from Gold Charts R Us that basically goes back all the way to 1970, the full freely traded gold era, in quotes. And what I saw was the chart shows the discrepancy between the Eastern price overnight after London has closed, and versus the compounding price of the Western market when London is open and it's traded in the Western market. And the disparity between the two prices compounding year after year after year from 1986, 87 roughly to today is profound. Absolutely profound. I'll send you the link after this interview just so you can see what I'm talking about. But you pointed about in that chart how in 1985, 86, 87 in your chart how the dollar performed horribly for those years because of the Plaza Accord, I assume, and the gold price didn't really scream off. And my hunch is there was some type of thing going on in London at the time, and it's kind of continued on even till today, if you just look at the compounding data of Eastern versus Western price action. So all in all, I've seen you talk in various circles and in some of the big gold industry conferences where you're sitting there speaking in front of hundreds of investors. I remember one profound statement that you made toward the end of your presentation was simply in the 2020s. At some point, it's going to get so silly that all you got to do is literally buy anything with the word gold in it, and it's going to perform better than the stock market. I mean, is that essentially how you feel?
Yes, I think what I specifically, I don't know if I'm remembering right, but I think what I specifically said is after the Fed cuts rates. I may have, I'd have to go back and look at it, but I think I may have said that, like, when the Fed cuts rates, just buy anything with the word gold in it. But no, I think it's true on a micro and macro level as far as the 2020s. I mean, you look at these, the long-term chart that I showed here, and looking at things from a real, bird's eye view, a multi-decade view. I see very strong performance in the 2020s. And I did write a book a couple years ago, and I'm updating it now. And I do have the titles that I think it's something about, gold outperforming in the 2020s. So it's definitely something I'm thinking about.
And in terms of allocation, I mean, this is not advice for any listener. Of course, this is educational purposes only, and we're just only speaking on our own opinions. What do you typically do for your allocations? For precious metals, do you like bullion, or do you simply stick with the precious metal miners? And then even on a larger scale, what type of allocation do you do outside of precious metals?
Well, I like to stick with the stocks, but at some point I do want to accumulate some bullion, do like a monthly accumulation plan. Mm-hmm. As far as, outside investments, I mean, I'm just 100% precious metals because I understand it best, and I don't like I'd like to put some money in emerging markets at some point because they've really underperformed, and I think, when we get into the next decade, and we're probably going to see a dollar decline and strong move in precious metals, and that, we get the dollar decline, emerging markets are also going to perform well. While you look at, U.S. stocks and the S&P 500, expected returns going forward are probably at best only going to be 2 or 3% a year for 10 years. So, I mean, as far as what everybody else does, I mean, I've read that, sometimes people say put 5% in gold, but that really doesn't make a difference. So you probably should do a minimum of 10%. I mean, I separate owning metal. I look at that as that's like a financial insurance position. Mm-hmm. So I think you should look at it as an investment versus insurance, because if it's like, if you just want to buy the metal and you're going to hold on to it for 20 years and not sell, to me, that's more of financial insurance than an investment. But I think, the simplest thing is, once the Fed gets into their next cutting cycle, or even a little bit before that, the simplest investment would probably be just a dollar cost average into, gold and silver every month. Like, that's the simplest thing that people could do if they don't want to, take on the risk of the stocks.
Yeah, and then one other question, I guess, on allocation for like majors versus miners. What is your take on that when you're thinking about precious metal, mining stocks?
Well, my take on that is it's probably best to, unless you really know what you're doing, it's probably best to own GDX or GDXJ, the two ETFs. I mean, you have to really know what you're doing, because like what people do who don't have expertise is they just, they find the biggest gold company and they just put money into that. And I mean that, and I follow the juniors a lot more closely than the big companies, so I'm more of an expert on those. But it's difficult because it's, you can have a bull market, but I mean, you could buy 3 or 4 of the majors, and 1 or 2 of them could just not perform that well. It's just like the nature of the business. So I would, rather than buying, like what I would do for most people, I keep it as simple as possible. Like what I would do if you want to own the stocks is and it looks like we're going to be going into a bull market, I would probably buy GDXJ. I would buy that, and or buy silver or gold, because, when we do get a bull market, I mean, silver is given how cheap it is relative to gold and relative to everything else, I mean, just silver might perform as well as GDXJ over a long period. It could even outperform. So That's what I would focus on. Keep it as simple as possible.
And if you are not an expert, then perhaps find one who you trust and who you believe in, and follow along and maybe take some notes.
Yes, absolutely.
Well, great. I wanted to give you a chance, if you could, to let our listeners know, Jordan, how to find you, where to follow you, etc.
They can follow me at thedailygold.com. I put out quite a bit of free information. I also have a premium newsletter. But like I said, there's a lot of free information. I usually write a public article once a week. I sometimes do video analysis, and the interviews that I do, like this one, I post them on my website. So, and I'm also going to be. I did write a book 3 or 4 years ago, but I'm updating that. So if you opt into my free email list, you'll get a copy of my book when it's done.
Well, that's great. I know the book writing process, that's a lot of work. That's real heavy lifting. So good luck with that. And I will, in the show notes on the show, I'll make sure to backlink where people can find you so it's easy for them to track you down online. And just on behalf of all our listeners, we really do appreciate you coming on, Jordan.
Well, thank you so much for having me. It's been a pleasure, and happy to speak with you and your audience, and I'll look forward to coming back in the future.